This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family's here. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and fighting.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode is with an experienced asset allocator who has operated at the intersection of insurance and asset management throughout his career. We sat down in Prudential's Newark studio with PGIM's head of multi-asset and quantitative solutions, Phil Waldeck. Phil is responsible for nearly $140 billion in AUM, where the business unit leverages PGIM's deep public and private markets expertise for the purpose of developing customized portfolio solutions to meet insurer and other investors' unique objectives. Phil previously served as Chief Transformation Officer at Prudential, CEO of Prudential's Workplace Solutions Group, and as President of Prudential's retirement business, which comprised of $250 billion in assets. Phil was also the architect of Prudential's pension risk transfer business, which he grew to over $170 billion. Phil and I had a fascinating conversation about the intersections between insurance and asset management. We covered the evolution of how insurers allocate to private markets, the importance of asset liability management, how insurers are leveraging their balance sheet to invest in private markets and collaborate with alternative asset managers, how insurance and asset management interacts, and the benefits of an integrated platform, how Pru's $1 trillion across public and private credit informs how they invest, and why insurers are allocating to private credit. Thanks, Phil, for sharing your perspective and wisdom on insurance and private markets. We hope you enjoy.
We're going mainstream.
Phil, welcome to the Altco's Mainstream podcast.
Michael, thank you. Great to be here.
Well, great to be here in the Prudential studio. Thanks for having me in Newark. I think we have such a fascinating conversation on tap today. Your background, I think, is so interesting as it relates to the evolution of both insurance and asset management, and now private markets, private credit in particular. So first, would love to start with your background. You've been at Pru for quite a long time, done a bunch of different roles. So let's start there, because I think that'll provide a really interesting evolution of the firm as a backdrop to your background.
Sure. Well, Michael, this intersection of insurance and asset management, that is PGIM and Pru. That's who we are. But it's also me, meaning I've sort of lived that, having grown up in the insurance, I ran the retirement business. So grew up in the insurance franchise, but there was such an asset intensive business, pension risk transfer being a great example of that, stable value, et cetera. I now lead a business within PGIM, which is serving insurers and reinsurers. So again, that intersection of insurance and asset management, that's been my focus for decades.
Two things I want to unpack there. One is your background first working in the insurance side with retirement. How do you think about that now, taking what you learned then and applying that to serving insurers in the multi-asset group that you built?
Well, job one as an insurer and an asset manager supporting an insurer is you got to understand the liabilities. And getting the liabilities and getting the ALM, the asset liability management, right, is the art of this. Meaning you've got to make sure that you've got the liquidity, you've got to make sure that under stress, that not just the base case where everything is smooth sailing, that you have the ability as an insurer to weather those storms and to capture opportunities when there's stress. That's when your existing portfolio has challenges, but that's also when spreads widen and there's more opportunity. And getting that right mix of public and private credit for the type of liability, and it varies significantly for really long life insurance liabilities versus short retail annuities, for example. Very different strategies would back those up.
On that point, how do you think about allocators thinking about risk? Because I think ALM gets to the heart of one of the big questions, particularly as it relates to deciding whether to choose public or private, which is liquidity risk or duration. How do you think about ALM in the context of liquidity as it relates to private markets products interacting with the rest of a portfolio?
Well, it's the intersection of the assets, the liabilities, and the capital and the regulatory regime that an insurer faces, and the accounting and other priorities. So, insurers have such customized needs, meaning you've really got to understand what the pebble in the shoe of the insurer is. Are they really worried about, if they're a publicly traded insurer, about gap volatility? And if you need derivatives for long liabilities to get that interest rate sensitivity so the assets move with the liabilities, well, how much appetite is there for volatility on the GAAP financial statements, and how much liquidity do you have on public assets to be able to post collateral and collateral under stress to support those derivatives? So getting the public-private credit has other component parts, and it's different if it's a U.S. risk-based capital insurer versus a reinsurer in Bermuda, or a Japanese insurer, or a UK insurer with Solvency UK. How do you optimize in the environment that insurer has to live in?
There's the insurance side of ALM. It also feels like the wealth management world, as they adopt private markets more, and you're sitting in the middle of that as both an insurance firm and asset manager. But the wealth management world seems to be thinking about ALM more as a way to think about private markets. How do you think that mindset of what you just talked about with ALM can or should, maybe it shouldn't, be ported over to the wealth management channel as it relates to the end individual client thinking about private markets?
Well, I think the retail individual investor does not have the same ALM construct as a institutional relationship, where that liquidity may be much more distant because of the nature of the cash flow. So if I take a pension risk transfer, those payments happen every month until somebody dies. Well, that's decades of payments. Very different than a retail investor who could take their money out even after maybe a market value adjustment or a surrender charge. There's still much more liquidity that the retail investor potentially has. And if you're using the ALM principles, that helps in constructing the portfolio, but it still has illiquidity, and there will be queues, and there will be credit cycles. And during those periods, the investor will need to have the staying power, because they won't all be able to hit the exit at the same time, and certainly not at the prices they would like.
You get to the topic of liquidity in that answer. How do you think investors, whether they're insurance investors or individual investors, should think about and approach liquidity?
Well, I think that's back to ALM. Liquidity is the thing that can really burn investors, can really burn insurers. So I think it's how do you have the right mix of public and private, and flavors of public and private, to create sufficient liquidity for the construct. And again, for a retail investor, it depends on their total portfolio and where this fits within their portfolio, because it wouldn't be an investor's only exposure. And if it's an exposure that they need to, pay college tuition with, it's not going to work.
I think that's a great jumping off point to what you do now, because you think about portfolios and asset allocation holistically. I think that's so important when you think about private markets. I think if we think about portfolios, they've shifted from this mindset of 60-40 to now, I think of it more as buckets and spectrums. So you're taking liquidity or illiquidity risk on the spectrum, whether that's public credit or private credit, whether that's public equity or private equity. And that's how investors are starting to think about things. How do you think about the total portfolio and how that relates to private markets? Because it feels like you have to really understand the total portfolio if you really want to make sense of where private markets fits in a portfolio and how it fits in.
Yeah, so I think I'll use the insurer example because I think that is most quantifiable and very well established practice. So you need to make sure you understand the expected cash flows, how those cash flows could change. If rates go up, if the currency changes, if people surrender their policies, that could create more liquidity than your base case assumptions. Well, how much more? And what would that then do to the overall portfolio? And what's your ability to weather that? So building the portfolio has to have that right combination of duration for interest rate sensitivity, private assets for diversification and for additional yield, and public assets for duration and for liquidity. That is a combination that, again, will vary by the nature of the liability.
How do you think about the adoption of private markets within an insurer's asset allocation?
Well, it's not a new thing. I think because the private credit arena has expanded so significantly in the last 5-10 years, people perceive as if it's new. PGIM and Prudential were issuing private credit in the 1920s. There's 100 years that we've been making loans to private companies for long-term liabilities. Now, the extent of that menu is much, much more complex today. And when people even say private credit, often they're thinking direct lending. Well, there's so many flavors of private credit. So what fits with what combination, that's a whole discussion in itself.
On that point, let's go there a little bit. So when it comes to an insurer's allocation of capital, are there certain flavors of private credit that fit better than others?
Depends on the liability, which I will always go back to. It depends on the liability in the ALM. So if you have illiquid cash flows, well, you can lock up private credit for longer time periods. So private placements can work really well there, both investment grade and below investment grade. If you have shorter retail annuities, floating rate type capabilities, securitized versions of private credit, private ABF, residential mortgage loans, floating rate capabilities, direct lending fits in that arena as well. And then part of this is not only the combination of flavors of private credit, but also how that fits with flavors of public credit. So if I'm an insurer and I'm trying to compete, I want the yield, private credit has an origination timeline that you need to then fill. Well, to do this well, you need to not only have the breadth of capabilities and the quality of what you're deploying, so it can handle credit cycles, but you also need to have the quantity of it when the insurer needs it.
I think you bring up a really important point, which is the edge in origination. How do you think about getting an edge in origination?
The best way to get an engine or origination engine is to build it over time. Fast isn't always best. And as you are deploying, this is where public and private comes together well. So, for example, if you have private CLOs with direct lending or other investment collateral underneath it, you can use public structured products until you get the private origination and then rotate into the private. But in terms of what to best build, our philosophy has been we have built this out over decades. We have a really deep credit culture with a well dispersed across particularly North America and Europe, but a global origination set of teams that have direct relationships. So in addition to sponsored and intermediated direct lending and forms of private credit origination, private placements as an example, commercial mortgage loans. We're doing so in direct negotiations, which means you get protective covenants, which means you have relationships with the firms. So they want to stick with you through good times because you've done workouts in bad times, both to not take the money back in a way that would be painful when they're under stress, but doing it with renegotiating the terms so you get paid more over time. It takes those skills, both origination, underwriting, protective terms, and then workouts. It takes all of that together, which is why that is best homegrown. Now, you can expand it through acquisitions, and we've done that. So DeerPath, for example, is an acquisition PGIM did in the direct lending space. But the trick there is to get really high quality and to have the cultures work. As you know, it's a talent business. You got to keep the talent and not do damage via an acquisition.
How would you define the talent and culture at PGIM?
It is a credit culture. It is a culture that is long-term focused. I would say it is a no drama culture. It's very, very high substance.
Some of those things I think describe in the DNA of an insurance firm well. I want to take it in a slightly different direction because as you were talking about the origination engine and what that means, at the end of the day, to some extent, you're responsible for real money and individuals and businesses or people at businesses. So much of private credit is actually financing a lot of these businesses on Main Street. They could be small or medium-sized businesses. As we know, the largest portion of $100 million plus companies in the US and globally, it could be Europe, Asia, et cetera, are in private markets. Because you're an insurance company that deals with real money at the end of the day and real people at the end as the end client, do you ever make that connection? And do clients ever really understand that connection of those two things, that you're really financing the engine of the economy, and then that may end up in their annuity or their policy or their investment that they have with you?
Yes, but. So the yes, but, Michael, is it certainly is part of our DNA in terms of purpose. So I think both on the asset management and the insurance company side, that is part of the culture. But also, I would say for borrowers, as opposed to retail investors, borrowers have that long-standing relationship. We had a client event at the Milken conference, and there was a borrower that had worked with us for decades. And this guy had built a wine business, so loaning to vineyards. We got a whole decades of experience loaning to California vineyards, as an example. And he described how he has built his business and how, in good times and bad, we've been a partner. And, it was something that made you feel really proud about how we've been a source of private capital, to your point, that is growing businesses that may not be as visible in terms of how people think about public credit markets. And the long-term capital that we deploy, which is third-party capital, as well as Prudential general account balance sheet capital, we've been doing that well for decades, and I think that's part of our identity.
We talk a lot about the investor side choosing private over public, particularly as it relates to credit. And in some cases that can make sense. In other cases, it makes sense to choose public credit. We don't talk as much about the borrower side choosing private over public. I'd love to unpack that aspect of things too, because that example illuminates that. But how do you think businesses think about the decision and maybe now have more options as they think about choosing private credit over public credit when it comes to the investment marketplace of where they can actually take in capital?
Well, again, this is a old trend, not a new trend. So while we've been such a large player in the private credit arena for decades, PE-backed asset managers are quite prominent in this space now too. But before them, it was about the banks. And the banks were tough competition over the years too. So borrowers can work with the banks, can work with asset managers like ourselves, and they can work in the public markets. And they're going to go where the right combination of priorities best fits them. So do they need a long-term credit relationship where it's not just about today, it's about borrowing in the future in tougher times? That might be a private arrangement. They might have something where they don't want public scrutiny, or they might not, so they wouldn't issue a public bond, or they might have a need that has both speed and execution certainty that's important, and complexity that the public markets might not tolerate as well. And as you know, we've got an enormous public credit business, and when you take our public and private credit capabilities together, it's more than $1 trillion in size. So we're a credit behemoth, but the borrowers have the same element of choice that investors do, which is why it's a natural continuum, and the boundary between public and private is blurring. It's not as crisp, this is private, this is public.
On that point, for you as an allocator of capital, how do you think having both of those businesses, the public and private credit business under one hood and at size and scale, $1 trillion plus, how does that help you think about this blurring of lines that we see between public and private credit?
And the only piece I would add to what you described in terms of public, private, scale, but it's also global. And just the extent to which you need to have those capabilities, both public asset management and private origination across the globe, it's a pretty short list that looks like us. And if I think about how to differentiate PGIM from respected competitors, there's lots of niche capabilities that are good in a sector, but to have the breadth of public securitization, private ABF, CMLs, direct lending, middle market and lower middle market, large cap direct lending. You just go across that whole continuum. I like the way we can construct solutions. And when you look at asset owners, their worlds have gotten really complicated. If it's insurers, it's gotten complicated because of competition, because of regulatory challenges. If you look at pension funds, what's the scale with which they've added strategies, especially in the private arena, versus a scale in which they've added staff? The former is growing a lot faster than the latter. Insurers and pension sponsors need to do more with fewer managers. That's where I think we can show up well.
I want to unpack that point because I think this is a trend in private markets broadly, which is there's less relationships that LPs will generally have. How do you think that unfolds, and what does that mean for the industry as you think about being an asset manager in this space, needing to provide solutions to LPs of all different types?
Well, I think one, it is the breadth of capabilities. And we just discussed that, but I think it's also the credibility in each of those arenas, because you still have to really deliver, and that credibility has to be sustained, which means that you have to have the capital inflows to be able to originate the private assets. You need to have the quantitative capabilities and the research capabilities, both public and private, and having, taking the RML arena, residential mortgage loans, that is a very data and operationally intense environment. You need to have scale to be able to do that efficiently and well. You need to have cred throughout credit cycles and to be able to retain your people and to show, if you look in recent years, everybody's got a good track record right now, but how do they do over longer periods? And the number of managers that have 20-year track records, short and few and far between.
What does that mean? Do you think you work with both institutional and wealth channel clients? Do you think there's certain clients who care more about longer track record? Because obviously there's now firms that are either partnering, manufacturing new products, they have shorter track records. Evergreen structures in some cases have shorter track records just because they've just started to exist. How do you think LPs, whether they're institutional or wealth channel, do you think they think about what you just said, and how do they think about that?
Well, I think they are putting their arms around these issues, and there's a whole menu of challenges that they need to understand, that they have to defend in front of their committees. So how do they model these assets? What assumptions should they use, especially if there's shorter track records, not only for the private credit originator, but sometimes for that sector or asset class. ABF is probably a great example of that. The track record isn't as long. Recent history is optimistically too good. Spreads are relatively narrow, so there's a risk consideration. How do you measure that risk? Particularly with private valuations, not having the measurement points with which you can then assess it with sophistication, and do you have the modeling skills, which is part of the firepower we can bring to the table, not only with our deep data, we think we have a data advantage, but we have a modeling capability that is valuable to outside investors.
One thing you're hitting on there is just how the asset management space is evolving. Firms can go at it on their own. They can partner. There's partnerships between asset managers and other asset managers, traditional and alternative. There's partnerships between alternative asset managers and insurers. How do you think that this whole space is shaking out, and how do you think about that?
Well, I think scale is going to matter. So it is helpful to be big because you have breadth of capabilities. And there are arenas where you need to partner.
How do you think that that's going to evolve as some of these private equity firms add other capabilities? Many of these firms are, to some extent, multi-strategy asset managers. Do you think there's room for both partnership and competition in other areas? And you think that will happen? Because you're also an insurance business, and a lot of insurance businesses end up partnering, and certainly the alternative asset managers want to partner with the insurance firms for a number of obvious reasons. How do you think that delicate balance will unfold?
I think there will be more and more of that. So, I was on the phone with a Japanese insurer last night. I met with Japanese bank today, a sovereign wealth fund from the Middle East earlier in the day. There's so many different players in this arena, and we will do more with insurers. Almost all the insurers, but for a relatively short list, do not have the private asset origination. PGIM is unusual being owned by Pru, having that long-standing private asset origination. There are PE-backed players that are creating marriages, establishing or acquiring insurers or stakes in insurers. So I think that trend's going to continue because for most insurers won't be able to build that from scratch. I described build being better than acquiring, and they will need partners to compete.
Something you talked about, I think, can be extrapolated to private markets in insurance portfolios more broadly, which is, what are you most concerned about when it comes to private markets being employed in insurance portfolios?
Well, I think it's back to liquidity and ALM. I think also there has been such growth in private credit, and particularly in ABF, in securitized capabilities, in large cap direct lending. There'll be a credit cycle, and there will be credit losses, and that will put pressure on insurers and on asset managers, and that will create some challenges.
I think a lot of people have talked about this, and in that context, they've talked about underwriting standards and making sure you work with a partner that's done this for a long time and that has a track record. It's not that people are blind to this, but I think to your point, there may be a cycle. What do you think allocators can do now to really think about the challenges that may come ahead at some point? And who are the types of firms that they should be allocating to today so they can avoid some of those things?
Yeah, so I think, again, it's a question of when we'll have credit cycles, and that's a debate. But so at some point, insurers will face this. I think what they will need are asset managers that really understand the liabilities, really understand the regulatory environment in which the insurer's operating, has the data to back up the insurer for its modeling and its regulatory conversations, but also its own internal risk and governance, which is this is a good time when things are relatively stable, when the next shock comes is not clear, but now is a good time to be going through your stress testing, and in particular to be stressing your liquidity. What is your ability to post collateral for those derivatives under rate scenarios when rates rise, spreads widen, policyholder redemptions? What if the assumption is too conservative and you end up with a more aggressive environment in terms of the combination that I just described?
What's the aspect within the private credit markets that perhaps you're focused on that others maybe are not as focused on right now?
I think it comes back to keeping the underwriting discipline and the discipline for terms, and doing so that you're not just chasing the opportunity. And in our case, that means direct origination is a great supplement to the origination that comes from intermediaries and sponsored back, and doing the Are You Sure tests on the credit underwriting and on the stress testing.
How does that happen in an environment where private credit has grown multiples within last few years? It's $1.7 trillion market roughly. Some people say it could be $30-40 trillion market if you include all certain things on a bank balance sheet. And there's also pretty significant demand from investors to invest into private credit. So how does the industry make sure it is cognizant of what you said, which is make sure you do good underwriting as there's a growing market and more capital flows into the space?
Well, that has risk associated with it. And I think it is much easier to give the money out than it is to get it back. And in times of stress, that will be tested. And I think individual managers need to have the culture and the governance that is rigorous, and it's really a talent and culture and capability thing, because if it's just about originating, then it's short-sighted. We're a very long-term organization, both on the asset management and insurance side, and part of our approach to private credit is we are a lender of private credit. We are not owning the same companies. If you have both the equity ownership and the debt, and you have on the same firms a stress scenario, whose interests are you representing? and there can be conflicts there. That's an example of the type of conflict that we don't have to deal with because we don't own the equity.
There's another interesting trend in private credit, which ties in private markets more broadly, but it ties into something you mentioned earlier, which is scale. So I'll share a bit and then want to hear your thoughts, which is there's this trend of private companies staying private longer. That's certainly benefiting the equity side of the equation, but it's also benefiting the credit side of the equation. Some examples, Apollo did a private credit transaction for Air France, for InBev, and these are for Intel, like multi-billion, $5-10+ billion. Blue Owl did one for Databricks. If private companies choose to stay private longer, or companies choose to go to the private markets, does that doesn't change the underwriting necessarily? You still have to underwrite well and originate well, as you said, but does that change some of the dynamics of this, where there's going to be so many quality options, even in a growing market with more capital coming in, that it could tamper down some of those challenges of certain firms competing for all the same assets, because maybe there might be other really high quality assets that enter the private credit space?
Well, I think there's both good paths and bad paths that could develop there. So yeah, you could have more assets and more companies that choose to do more in the private arena. You also have to be careful about too much capital chasing the same borrowers and making sure that there's discipline there. But then there's other markets where there's less developed capabilities. So I would expect that there will be more happening in Europe over time, and particularly if Europe takes action, and it's not sure they will in terms of private securitization, but the securitization markets in Europe, there's an opportunity for capital to be deployed better and not just have bank lending dominate the way it does in Europe. And there are other arenas. The private credit market is very small in Japan. Even the public credit market is relatively small in Japan. So there are market opportunities that should develop over time. Doesn't mean they will, but I think the scale of the opportunity, if we're looking out a decade, should be meaningful.
So on that point, thinking about looking out over the next decade, you've been in this space for quite some time, both public and private. What going forward are you most intrigued about as it relates to private markets?
I think the striking the right balance on liquidity, as we were describing it earlier, and making sure that you've got the right regulatory framework so that good governance and good regulation is healthy for the industry.
How do you think asset management firms, and in your case, both an asset manager and an insurance firm, can help getting it right on the regulatory front?
That's something we've been very committed to, and we're proud of the relationships we have with our regulators. It's really important for leading asset managers and insurers to weigh in on how they think it ought to be governed. And our peers and competitors, we would welcome them at those tables.
On that point, from the perspective of what would be for public consumption, what do you think is important from an education perspective? Whether it's regulators, it could be to end clients, particularly the end individual investors, wealth channel investors, about the merits of private markets that would help them understand what this opportunity set, but also the risk look like?
I think ALM, liquidity, and then the breadth of the liabilities and the breadth of private credit. So back to private placements, direct lending, directly originated versus sponsored, CMLs, asset-backed finance, RML, private CLOs, rated feeders. There's such a complex menu. And when people say private credit, it's like saying food. And the breadth of things that are on that menu is extraordinary. And if you only eat the sugar products as opposed to these flavors of protein with those vegetables, just the complexity of it requires the right understanding. So ALM, liquidity, and breadth of liabilities, breadth of assets, combine them correctly.
If you could create the perfect meal of private credit, what would that look like in your mind?
It would depend whether I'm having a PRT breakfast, whether I'm having a retail annuity lunch, whether I'm having an afternoon snack that is whole life insurance. That meal is entirely dependent on the liability. And I think that's also the dynamic that is changing. The insurance industry used to be, I have these liabilities, what assets do you have? Now it's, I have these assets, what liabilities are the right combination? And you will see pricing and scaling up based on asset supply informing the liabilities, but that perfect combination depends on what you're using it for.
What do you think, particularly for the wealth channels, those investors should be eating more when it comes to private credit?
I think a diversified mix of private credit, so not just one flavor, and that they should be doing it in a way that is eyes wide open, that that portion is not short-term liquidity. Even these quote-unquote semi-liquid products have constraints, and don't count on it for liquidity, count on it for diversification, count on it for incremental yield, especially when spreads are tight.
Do you think discipline in investing will start to taste better over time? Like eating your vegetables doesn't always taste good in the beginning, but maybe people grow to like it. You think there are aspects of that people can learn on the investing side as well?
I think some people will learn it, others will get coaches, meaning advisors, and I think probably for the retail investor, the advisor is going to be the art here in terms of how to do that well, because this is quite complex, and the mix of private assets varies based on capital markets at the time that you're deploying the assets. So today's answer will be different than the answer a year from now.
The other interesting aspect of all of this, though, is that when you think about food, there's now so many choices. You go to the supermarket, the shelf space is tight, and there's a breadth of choices. How do you think about shelf space and choice as it relates to all the different solutions or products that particularly the wealth channel now has to choose from?
Well, it can be overwhelming. Now that we're working this food theme, I shouldn't have tossed it out there, Michael. But the breadth of those capabilities gets back to the do more with fewer firms. And if we're able to have, a Walmart of choices, but can combine it into an attractive meal, so you don't have to choose every single ingredient, it's already packed, whether it's HelloFresh or whoever packages it for you, how do you have all the ingredients and put together so it works for a good meal?
I'll borrow something that some firms have used, which is the farm to table analogy in private credit. I think John Gray either came up with it or used it. Blackstone has talked about it a bit. How do you think about, there's almost this interesting, if we use the food analogy, there's this interesting trend of, on one hand, it's scale, which makes me think of like, well, Amazon bought Whole Foods. So you have large firms who are the ones who are distributing, whether it's the high-end product, could be the low-end product as well, all going to one place because it's more of a one-stop shop. On the other hand, with something like private credit, you have farm to table, and I know that's more on the investment side rather than the distribution side per se. But how do you think about those two elements of things? Because I think when you think about the way this is unfolding, particularly private credit, that is a scale game. You can't really be an artisanal player, or you can be, but then you get acquired. How do you think about those two trends kind of shaping the private credit market?
Back to I prefer organic building of capabilities and teams over time rather than fast acquisition and cultural challenges. But there is a tension there, which is there is a breadth of a menu, but there could be some specific niches that you don't have. So, we have arenas in which we either won't have the capability or won't have it today, or we'll need more capacity. And so you can take other pieces and bring that into the picture. But back to my public and private credit, great breadth. That's part of what I like about working at PGIM.
Relating this to something else you mentioned, which is it really comes down to talent and people in many respects. How do you think this unfolds from the perspective of talent? Because when I think about scale, particularly in private credit, I think that firms that have the scale in many respects have an advantage, not just in origination, but also in distribution. And that makes it much easier to build and scale a business. So does the talent tend to stay at top firms now? Or do you think we'll see, and yes, there's always people who want to be entrepreneurs, but if you think about private equity or private credit 20, 30, even 15 years ago, you had a lot of talent that would have spun out at the natural time for them to spin out and start something smaller because they could. Now, because distribution, particularly the wealth channel, requires scale, how does the talent game unfold?
Well, you think about the private credit arena, people that are private credit, stars in terms of that talent, they're going to want to be able to originate the loans. They're going to want to be able to have a predictable and scalable, steady stream of capital to deploy to the borrowing relationships that they've built over time. And if they can't get the capital, even if you're in a great culture, you'll be tempted to work someplace else, either as an individual or a lifted out team. So I think the distribution part and the brand and the scale matters, but you also have to have the culture. Often scale is toxic to investment cultures. As firms get bigger, many of them struggle to keep the culture. And that's where having the right leadership and the right core culture, as you get bigger, still keeping the quality and the things that those private lenders respect and value.
So you need to give great chefs all the tools and products they need, but in a bigger scale platform.
And with a steady flow of customers into the restaurants, that those chefs aren't Maytag repairmen. They're actually delivering the meals. That's their identity and purpose, why they do it.
Where brand matters.
Exactly.
Wow, we really did a great job with the food analogy. This was a fantastic conversation. Phil, what an interesting perspective into such a breadth of a platform across insurance and asset management. Your career has mirrored that as well. And then we cooked a great meal together.
Yeah, it was a lot of fun. Thanks, Michael.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going